This is Daybreak Asia. We're counting down to Asia's major market opens. And Paul, I think probably one of the key things we're going to be tracking today is just whether this ends up being a sort of wait-and-see session, given the amount of different items on the data docket, but also key earnings releases that are ahead.
Yeah, that's right. And it was a rough ride for markets, of course, last week. A number of unappealing superlatives set by a number of markets, including the S&P. The Nikkei had a rough week as well. China did pretty well, though. It's going to be an interesting session, though, as you say, to see how investors respond and whether or not they respond at all.
Yeah, well, of course, some of the action in the Friday session was down to the tensions in the Middle East. It sort of dissipated throughout that day of trade, but it was that close of Wall Street. And as you said, that big drop that we had in the likes of Nvidia, Tesla, in fact, the worst drop that we've seen for Nvidia in about 4 years. What we're tracking today, though, in the session is the outlook for the Japanese yen. Still trading here very closely to that 155 mark. We do have the BOJ decision coming up this week, and it really is sort of a catch-22 situation for BOJ officials, given that you've got a weak yen that could be adding to the inflation story, but still they're not likely to hike at this point in time. Weak yen, of course, it supports the exporters. Today we're just seeing stocks a little bit firmer, but in the context, as we said, that big sell-off that we had on Friday, given the news of the retaliatory strike for Israel on Iran, dropped during our trading hours. So we did see sharp losses there, particularly in the tech sector. Let's change on, take a look at what we've got for Korea at the start here, because, again, you are just seeing moving a little bit higher. We've actually got some trade data dropping as well. First 20 days of April numbers for trade and exports rising 11% on the year. Something that is positive, of course, not only for Korea, but it is considered a bit of a barometer for global trade. So that could perhaps play a little bit into the story. Korean won, again, you're seeing it a little bit firmer here, but it has been against that backdrop very much of King dollar. So just recapping there, those trade numbers for the first 20 days of April. Exports up 11.1% on the year. Imports as well gaining by the same magnitude, or rather, actually, I should check that. Just misread that one. But we do have, as I said, the first 20 days of trade data dropping, and imports, rather, a rise of 6.1%. So a reversal from a contraction the month prior.
Well, we've just opened for trade here in Australia. Of course, it is a staggered open, but we are seeing some pretty modest gains. BHP among the early movers, that stock better by 1.4%. It really continues a theme that we saw towards the end of last week, even though we saw losses on the ASX. Gold stocks in particular did well. Energy stocks did pretty well also. But we're seeing Brent crude coming off some of its highs at the moment, off by about 2/3% in the early going. The Aussie dollar holding pretty steady there, just above 64 cents. In terms of yields here in Australia, we've got the yield just creeping up a little. It did slip in the early going, but we've opened for trade in US debt as well in Japan. So let's take a look at how we're tracking there. Bonds have been heading for their worst month of the year, and we're seeing a bit of a tick up in yields at the moment. The 2-year just knocking on the door of 5% now, so it'll be interesting to see whether or not it crosses that threshold. As I guessed earlier, Diana Messina noted that yield curve is still inverted, and it's going to be an interesting week as well. There's $183 billion in 2, 5 and 7-year sales coming up, so we're going to have fun watching the markets absorb that, Annabelle.
And what else markets are going to be absorbing is certainly the big reports that we've got coming out from big tech, earnings arriving this week, right in time for investors looking for an AI-powered rebound, or perhaps not. We'll see what comes out. But let's bring in our next guest, who's cautious on the AI theme. This is Vicky Chi, Asia Equities Portfolio Manager at Rebecca. And yeah, we've seen so much optimism that AI would lead to these big productivity gains, really boost bottom lines for companies. But you're a little bit more cautious, it seems.
We've been in this beautiful rally for over 1.5 years now. And Asian semiconductor supply chain has been really fully participating in this AI thematic. And the way that I look at it is really, I think as a sector, we're definitely having some kind of risks of overestimating the near-term importance of this whole new infrastructure investment in AI. And I think I'm cautious in the sense that expectations would have to be rebased, and some of the stocks have definitely rallied way more than they deserve, and earnings probably would not be able to support that. So overall, I think stock selection remains to be very important. Which companies can actually deliver the earnings and have the pricing power in this whole rally, and that can sustain that with earnings. And some of the stocks, unfortunately, I don't think they will be able to keep going.
So what sort of timeline are you expecting to see any sort of gains from AI on? I mean, it seems inevitable that AI will change our lives perhaps in really big ways.
Absolutely.
But are you saying that the timeline has been pushed out, or how do you sort of tone down the FOMO in a meaningful way?
Yeah, so I think for investors, this is obviously a very important thematic that's going to lead to extremely strong productivity growth down the road. But indeed, timing is the big question, and it's been extremely risky to underweight this thematic for investors in the region and globally up till now. But I think, again, at this moment, we are not seeing the killer apps coming through, right? So even though we're all using meeting notes, functions in different apps to help us using these AI apps, but they are not, in terms of profitability and revenue impact, that significant. That's enough to support sustained infrastructure investment in the semiconductor supply chain. So I think as investors, on the one hand, we need to be aware of the market momentums and cannot be too underweight given the very strong momentum. On the other hand, from earnings and stock selection perspective, we need to be very careful and selective.
Yeah, it was a very rough week for IT stocks last week in both Japan and Korea. And the Nikkei more broadly is now down about 9% from its March peak. But we've got a chart on the Bloomberg terminal here that shows the CSI 300 was actually up last week and is now beating the Nikkei. Do you think this is maybe the start of a trend? You know, maybe we're seeing some profit taking in Japan and a bit of investment in some of those really beaten up Chinese names?
Absolutely. I think there's been definitely a very volatile shift happening in the market. And in Asia, we've seen currencies move very dramatically. And China is, has been the drag of the market, and that has stabilized somewhat. So I expect this kind of volatility to continue with the rate confusion in the market or reset of expectations in the market. In terms of the Japanese market, we still hold a very positive view there. But obviously, the yen has been a very strong focus for investors. So the way that we look at it, we need to be very focused on selection within Japan, and what we still like is really the Japanese properties. So we still see the domestic Japanese property as one of the promising areas to invest in.
Do you also like some of these other names that have perhaps been a bit on the nose recently, particularly oil, energy stocks, fossil fuels? They have been doing quite well, perhaps at the expense of some of the more sustainable investments.
That's a great question, and I'm often asked by investors, how do you actually even look at sustainability in Asia in this kind of light? And my answer would be that we are still in the very early stages of sustainability development within Asia, and I think the conviction from the top to the bottom in Asian countries is very high. So sustainable development remains to be an area where it's often overlooked by investors, especially when oil price is doing well. It seems to be much simpler to just invest in oil and invest in the brown energies. But actually in Asia, sustainability development is still very much ongoing, and I would actually like to argue that there is a tremendous investment opportunity here for investors to achieve alpha, so actually excess returns over the oil stocks by investing in new energy infrastructure in Asia, by investing in electricity grid across the region, and by investing in, for example, natural gas, which is also an important transition fuel for a lot of Asian economies.
Something else that might take a little while to bear some fruit is Korea's Value Up program. And we've seen investors leaving that market just because they've been a little bit disappointed with what they've seen so far. But how long do you think until we start to see any sort of concrete returns in comparison, for instance, to what we've had in Japan?
We've definitely seen that episode before. In Japan, it took a long time for the consensus to be built and for the corporates to actually step up, for management to step up and to really take a critical look at their shareholder return programs and really commit to optimizing their balance sheets. So In Korea, we expect something similar to happen, but obviously the market recognized a similar pattern and have rallied up very, very quickly. And again, indiscriminately, a lot of stocks went up all at once. And in our experience, as one of the first institutional investors that signed up to the stewardship code in Korea, we see tremendous differences and divergence among different management of different companies. So the companies that will change will enjoy a much better valuation over time compared to the companies and the management that are very slow to move. So again, we believe this remains to be a very interesting thematic for investors to invest in Asia, as we're trading at such a large valuation discount compared to the global peers. And this would be another question about stock selection, but we remain optimistic about value up program in Korea.
All right, Vicky, thanks for your time. That was Vicky Chi, their Asian equities portfolio manager at Rebecca. And we are just pretty much bang on 10 minutes into the session so far, but tracking tech stocks in particular. These are names that are linked to NVIDIA. And of course, that story on Friday was the significant drop that we had for that US-based chip maker. But or chip company, but we are seeing companies that are linked to NVIDIA as well, a little bit weaker so far in the session. The biggest decline that we've seen for that company in 4 years. Supermicro as well, another AI name that had been sort of seen as an AI winner, slumping sharply on Wall Street. So that's one thing that we're tracking. The other one is Nissan. We're just seeing that stock come online. Pretty big drop so far. We have biggest decline actually we're seeing going back to March. But we have got Nissan under pressure so far, given its full-year profit has missed estimates. Its full-year operating profit coming in at $3.4 billion, and that was 15% lower than it forecast as recently as February. So, Paul, really that story of sales just falling short of expectations.
Yep, Nissan declining a little bit there in early trade. Still to come, our exclusive conversation with Philippine Finance Secretary Ralph Recto. We're going to discuss his outlook on monetary policy and the weak peso later this hour. First, though, a US bill forcing TikTok's Chinese parent company to sell up. That could become law within days. We're going to discuss the implications of that next. This is Bloomberg. A bill forcing TikTok's Chinese owner ByteDance to divest its ownership stake is on a fast track to becoming a law in the US. The legislation was included in a crucial aid package for Ukraine and Israel, and that was passed by the House over the weekend. Our global business editor Karen Lee joins us now. Karen, the author of this bill, Michael McCall, called TikTok a spy balloon on America's phones. So this app isn't going to delete, this bill is not going to delete the app from Americans' phones. How is this going to work? What's the next step?
Yeah, no, it's not. And it's crucial to remember that TikTok is used by tens of millions of Americans, especially young people, and it's really become a staple of life in the country. People are getting political news from it. They're getting recipes from it, exercise plans. It's not just about keeping in touch with your friends. You're potentially looking at removing a major source of news. So I think a lot of people are concerned about not just what the removal of TikTok or a change in TikTok would do for that group of people, but also how TikTok is using data, how TikTok might be using what people are posting. And there's been a lot of debate about that in the American government and among American people for a long time now, and it seems to be coming to a head with this.
Karen, we know that TikTok's making some personnel changes in the US in this preparation to really fend off the US law, or possible US law. Is there anywhere that the US really misstepped, or TikTok rather in the US misstepped here? Is there something they could have done differently to convince lawmakers?
Well, it's interesting, Annabelle. The general counsel of ByteDance and TikTok in the U.S., Bloomberg is reporting exclusively that he's going to be removed from the role in the wake of this, but TikTok and ByteDance are saying that that is not the case, and we're also reporting that they're going to pursue exhaust legal action. So it's going to be interesting to see what they're able to do and how this plays out, especially leading up to the U.S. elections in November, where The U.S.-China relationship is obviously going to be a focal point no matter who gets into office. So we're going to be watching this very closely to see what it means for TikTok and also what it means for that relationship as a whole.
What's it going to mean for ByteDance and its bottom line?
You know, it's interesting because ByteDance is obviously a Chinese company, and China in recent weeks has been fairly restrained on the U.S. It's held back, so it's going to be interesting to see if this is something that really pushes China to say something or if it's just going to deal with it as it comes.
That was our global business editor, Karen Lee, there. And sticking with China, because President Xi Jinping has ordered the biggest reorganization of the nation's military since 2015. It's a move that will affect the force in charge of capabilities, including cyber warfare. For more, let's bring in Greater China Senior Executive Editor John Liu, who is joining us this morning in Hong Kong. And John, how much is this about preparing China for modern warfare?
I think it has to. I think that is a big part of it. If you look at what they've done, they've elevated the importance of aeronautics. They've elevated the importance of cyber. Those are both areas where there's intense competition with the United States. I think that's probably the driving force. There's obviously another factor here is we've seen a big turnover in the defense arena in terms of personnel. We had the defense minister removed. The head of the strategic support force that is being now removed, that person has not been seen for a while either. And so there is some political sort of things happening underneath all this as well.
John, we've also got Secretary of State Antony Blinken heading to China, the latest in quite a long procession of U.S. officials to head over to China. In what respect is this mission going to be a bit of a diplomatic tightrope, though?
So on one hand, Secretary Blinken is making this trip because of the meeting between President Xi and Biden in San Francisco, and they are trying to continue the sort of détente that has come out of that meeting, out of APEC at the end of last year. On the other hand, there are lots of problems, the biggest problem of which is Russia, Ukraine, and Chinese support of Russia. As Secretary Blinken already talking about earlier last week, how much objection there is to Chinese supplying Russia with so-called dual-use technologies, things that can be used for missiles, but also used for commercial purposes, for cars, for electronics. And that is a big issue that we are expecting Secretary Blinken to bring up when he is in Beijing.
And again, it really comes back down to that sort of competition and returning to that idea of China's military. Do we have clarity, as you mentioned, these personnel changes and people that haven't been seen in public for a while? Have we got clarity on who really is leading these key positions in China's military at this point in time? And also, because there's been that question in the past of China being prepared in terms of weapons, but strategically not ready either for combat.
I think Xi Jinping has made it very clear that his objective is to get the Chinese military to the point where it could fight and win a war. Whether that is, in fact, the condition that the military finds itself in today, I think that's questionable, especially if you have so many high-ranking officials being moved around and removed. At the same time, that effort is not going to change because it's even though we may not have great certainty about who's in charge of the military at any specific rank. We know very well that Xi Jinping is in charge, and it's very clear what he wants to do.
All right, Greater China Senior Executive Editor John Liu there. Well, the U.S. House of Representatives has passed $95 billion in fresh aid for Ukraine, Israel and Taiwan, and this ends a 6-month-long political deadlock. The Senate is expected to pass the package later this week.
This aid will strengthen Ukraine. We did lose the initiative there. Now we have all the chance to stabilize the situation and to overtake the initiative.
All right, for more on this, let's bring in Bloomberg's Michael Heath. Michael, that was like pulling teeth. It took a long time to get there. Can you tell us how important this is for Ukraine? And as November gets closer, is there a chance this could be it?
Yeah, Paul, good points. I mean, Winston Churchill once said that the US always does the right thing after it's explored every other option, and this is really a case of that. Look, it's hugely important for Ukraine. Russia was taking advantage of its lack of ammunition, of its struggles to get enough men into the line. So it'll have a morale boost, and it will also probably stabilise the situation, as President Zelensky said, which is hugely important. They've been on the back foot, and Russia's been taking advantage of this. Russia watches very closely what goes on in terms of the US-Ukraine relationship and Ukraine's relationship with the West. But you're right, and, you know, in November, if you get a Trump administration, and Trump is so positive towards Putin, and you know, it's been reported fairly clearly, just he has almost sort of this idolisation of the Russian leader. There's every chance that the plug could be pulled, and then it's really going to be up to Europe to step up. Can Europe do it? It's fairly doubtful. So, I mean, Ukraine has an enormous amount riding on this election, and Russia has really got the wind behind it at the moment. The other thing with Russia you always see is the longer a war goes on, the better it gets, and you can see it's starting to improve now as well. So Ukraine desperately needed this.
And Michael, part of this funding is also going toward Israel. We understand, we're hearing from Netanyahu that could partly be spent on operations in Gaza. Doesn't really seem like that is the direction that the White House would want, even though they did call for further assistance. Yeah,
I mean, Annabelle, look, the Israel side of it, I think it was essential that this package linked those two together, just to get everybody on board to pass it. It was just so important to pass it. And the US is never going to leave Israel without the ammunition and the wherewithal that it needs. But yeah, look, Rafah will come back onto the agenda. Obviously, everyone was very, very closely focused on Iran, and Gaza sort of took a back seat to that. Israel's strike, Iran has played it down, and everyone has praised it in the West, even though they didn't want Israel to retaliate. Its strike was very much just a case of, look, where we can get to you, but let's leave it at that. And Iran playing it down sort of means that this is quieting things down. But I think the US aid is important too, because even putting aside Rafah and the worries there, the baseline has risen for fighting between, state-to-state fighting between Israel and Iran. And obviously you've got Hezbollah on Israel's northern border as well. So, you know, Israel's security position has deteriorated slightly in terms of Iran now showing its hand with this. But I guess, you know, it really depends if Israel does go ahead with Rafah, then Iran falls back into the background. If it waits a bit longer, then people will keep focused on that. But the US was always going to support Israel here and always ensure it had the wherewithal. So though if it goes on and attacks Rafah straight away, it perhaps mightn't look so good. But I think in the case of Iran, everyone knew that they had to have this.
That was Bloomberg's Michael Heath, and we'll have more ahead on Daybreak Asia. This is Bloomberg.
There is no such thing as free trade in steel. The market in steel globally is significantly distorted by what we are calling the non-market policies and practices coming out of China.
All right, that's US Trade Representative Catherine Tai speaking there to Bloomberg. Let's take a look at how some of these commodities are tracking at the moment. Iron ore prices softening just a little. Of course, iron ore very much a bellwether for what's going on in China, very important to Australia as well. Currently declining by about 1.2%. Seeing a little bit of softening of the oil price as well. Brent crude now 86.79. This is, as we've been discussing, that tension in the Middle East just de-escalating a little. Israel and Iran seem to be on some sort of off-ramp in terms of dialing back the tension a little bit. Gold price, that's also backed off a bit as well, 2,398. So back from the 2,400 high. Gold still up 10% this month, though. Still to come, big banks, including UBS, HSBC and Morgan Stanley, are cutting back on jobs in Asia. Recruitment agency Robert Walters is going to join us to share their outlook up next. This is Bloomberg.
We're hearing it's all big tech, right? That's what some of the headlines are this quarter is about big tech.
Big tech has great balance sheets with a lot of cash and very little debt.
Mega cap tech companies that are generating extraordinary amounts of cash flow. they're still actually doing very well.
Tech is a big part of the quality story.
And we still would expect for this quarter in particular for many of those companies to lead on earnings growth.
If you look going out, 1, 2, 3 quarters, I mean, it is going to start broadening out.
You can't have tech be the only thing that does well if you're starting to see economic weakness in other places.
We're just ramping up earnings season now, and I think that's going to be a good distraction for the market to be able to sort of have a look what's actually going on, to see whether the lofty valuations are actually supported by the fundamentals.
Bloomberg TV guests there on US tech earnings. It's going to be a very big week for US tech earnings as well, with the Magnificent Seven, many of them reporting. And on that topic, we've got the results of our MLive Pulse survey. Do love a good survey. There were 409 respondents to this, so that gives you a sense of the margin of error. But will this earnings season give the S&P 500 a boost? Well, a lot of optimists out there. 63% think so. 37% think that it's not going to be so good, and we could see the S&P take another leg down. Had a couple of other questions there as well that stood out to us. What is the biggest headwind to 2024 earnings globally? 10-year Treasury yields climbing above 5%. Well, they're not there yet, but certainly the 2-year yield is knocking on the door of that. Companies not delivering on AI, that's another concern. Oil, yeah, that's a distant third. One more question we want to take a look at for you was what would be most likely to make you add exposure to dividend stocks? Well, it's not the Fed. It's an underwhelming earnings season, which would make 42% of our respondents, that is 172 respondents, in fact, would make them want to add exposure to dividend stocks. So there are a number of other questions on that MLive Pulse survey, but those are the three that really stood out to us, Belle.
Yeah, and Paul, something else that really stands out to us, and just given the number that we've been seeing, is job cuts, always something that's very closely tracked by our audience. But this graphic here, taking a look at some of the ones that have been announced, either by the company perhaps, but more likely down to sourcing, different organisations. Well, Reuters is playing into this, but the likes of Deutsche, Morgan Stanley, HSBC, UBS, Bank of America, all some of the names that have reduced headcount just in the last few months. Hong Kong, mainland China, they've certainly been bearing the brunt of this. So let's get more with our next guest, who says that there actually could be further reductions to come. John Mullally is Managing Director for Hong Kong at Robert Walters. And where are we, do you think, in the redundancy cycle at this point in time?
It's a good question, Annabelle, and it's very hard to call it. I mean, we've been speaking to a lot of clients right now who are saying that we're kind of really at the bottom in terms of where those cuts are. I mean, this has been happening now for almost 2 years. You had a glut of hiring from the beginning of 2021 to the middle part of 2022, and by mid-2022, when we were speaking to the banks, it was clear that the revenues coming through and the pipelines coming through weren't really supporting the amount of hiring they had done. So I think you have to consider where they're coming from a base perspective to where they are now. The sense we're getting is that there's probably going to be a little bit more trimming over the next kind of quarter and a half, but that as we go into the second half of the year, there will be some improvement. But that isn't going to necessarily result in hiring anywhere near the levels of 2021, but probably some off-cycle hiring all right towards the latter part of Q3, maybe early Q4.
Yeah, because we talk a lot about pre-COVID levels. I mean, when we go back, and are we going back to pre-2019 sort of hiring trends, or is this about creating sort of a new normal as well?
Yeah, I mean, I suppose the reference point we're using is 21 and 22, and that was where there was a significant amount of hiring in, well, it was a kind of a quasi-post-COVID bump in terms of recruitment. That's the kind of benchmark we're looking at. Going back to 2018, 2017 isn't necessarily relevant to the world we're in right now.
What impact is this tighter job market having on salary expectations?
I suppose people have become a lot more amenable, Paul, to making that move. There are less positions out there, and when those supply-demand factors favour employers, what you get is a candidate market that is more open to making moves. I mean, if you look at the percentages people were moving, say 2-3 years ago, you're looking at 25-30%. You're looking now closer to 10-15%. And again, in certain parts of investment banking, especially at the senior level, people are moving for kind of flat rates, really. They're not really looking for percentages. They're looking at where are the opportunities.
To what degree do you think hiring is really depending at the moment on the state of the Chinese economy? And are you seeing any signs of encouragement there?
Again, it is in Hong Kong, especially for investment banking, it is hugely dependent on the Chinese economy and hugely dependent on companies coming to market looking to raise capital through equity or debt issuance or engage in M&A activity. There, again, the sense we're getting is that we're at, they're calling this the kind of bottom of the market and that things will look to improve over the next couple of quarters. I think with banks, though, given how they've gone on this cycle of hiring and then almost immediately having to reduce workforce, they're going to wait for more than just 1 quarter of activity before they really start ramping up hiring again.
John, are there any specific sectors or roles that you think are most at risk?
Clearly, anything in the IPO sector, given how that market has performed in Hong Kong, equity capital markets, they tend to be more at risk because there's less activity coming through. But again, we are looking. I mean, financial services is a very broad spectrum of firms, of activity, of functions. I think we tend to hone in on front office investment banking jobs, especially when these job cuts come, and especially because they are some of the highest earners in the industry as well.
We talk a lot about the competition war between Hong Kong and Singapore. Where are we at in that as well? Because a couple of years ago, it was that story of everyone was sort of fleeing to Singapore. Now there's sort of the question mark, are they coming back? And are you seeing sort of different salary expectations between the two cities as well?
I would say that the salaries across Hong Kong and Singapore now are broadly similar. It used to be the case up until probably about 3 years ago that Hong Kong, there was always a little bit of a premium. Hong Kong was seen as a more expensive place to live for a start. And just the kind of the deal size and deal pipeline in Hong Kong was always heavier and more attractive than Singapore. So as a result, bankers in Hong Kong, commanded a bit of a premium. Now it's kind of flat. In terms of people coming back from Singapore to Hong Kong, I think there's an appetite for that from individuals. However, the job market itself isn't supporting that. So it's, bankers and financial service professionals will go where the opportunities are. And right now in Hong Kong, there's a paucity of opportunities. So that is preventing that degree of migration that we potentially would be seeing in a healthier market.
And is there any sort of preference for other places like Tokyo, for instance, or Dubai even, for people that are looking or chasing, well, Dubai at least a low tax rate? Yeah,
I would say the Middle East and Dubai is a more realistic option for bankers being out of jobs here in Hong Kong. Tokyo tends to be one, I suppose a little bit more of a language requirement. Two, it is a very distinct market where a specific network and track record and experience is required. I think Dubai is more of a realistic option.
All right, John Mullally, Managing Director for Hong Kong at Robert Walters. Thanks so much for joining us. Well, let's take a look at how we're tracking on markets. At the open, Belle and I were wondering if maybe investors would sit on the sidelines today. No, they have decided, in fact, that this very much looks like a dip worth buying. Here in Australia, we've got the ASX up about 1.25% at the moment, and we're seeing equities rebounding everywhere. The Nikkei better by 0.6%. And the Kospi better by 0.75%. In terms of sectors, it's a pretty broad-based rally as well. It's really only energy here in Australia. It is in the red. In Japan, IT stocks having a rough day, but elsewhere, pretty much every other sector in the green. In terms of tech, let's take a look at some of these Tesla suppliers as well. Well, they're all doing pretty well as well, and that's notwithstanding our expectation that we're going to have a pretty interesting earnings announcement from Tesla this week. Its stock has slid more than 40% this year amid slumping sales. We saw a lot of redundancies at Tesla over the weekend, and also this announcement from CEO Elon Musk that, well, maybe we're not going to do a low-cost vehicle after all, and the focus is going to shift to robo-taxis. So, yeah, upheaval, the watchword at Tesla at the moment, but suppliers still performing pretty well in the early going here in the Asia Pacific. Well, the IMF's first deputy managing director says the potential for oil price shocks from escalating tensions in the Middle East would be problematic for the global economy. Geeta Gopinath also discussed the outlook for US interest rates at the IMF spring meetings.
This is a risk we worry about. If there is a serious escalation, which means a much more wider regional escalation than what we've seen so far, then yes, we could have a severe oil shock. But we're not there yet, and as you can see in terms of oil prices, it went up some, but it's come back down. We have supply excess capacity in Saudi Arabia. We have non-OPEC countries putting a lot more oil out on the market. So there are other sources of supply that can, buffer these shocks. But if there's a large-scale escalation in the Middle East, that is a problem.
Is that the line in the sand, $100 a barrel, and that would consist of the shock?
I think going up $100 a barrel would be problematic, but even going from here to $100 a barrel would be difficult for countries to deal with who are still fighting the last inflation fight, which is to bring inflation back down to target.
One thing that the IMF has talked extensively about is concern about sovereign debt, in particular in the United States and the overhang there. What's the outcome of that? Is the fear of some sort of slugflation or just sort of a sluggish growth kind of picture because of the overhang? Is it higher rates and potentially a Liz Truss moment, which I've been talking about and get shocked at all the time in the U.S., but is there something like that that could potentially happen?
The U.S. is running very large deficits for a country where demand is very strong, and there is still the last mile in terms of bringing inflation down. So for all those reasons, the deficit, you can't have a deficit with 7% of GDP. It needs to be lower. And if you project out, it's going to stay at those high levels for a while. That has consequences, of course, for debt servicing in the U.S. But in a sense, the bigger problem is in terms of spillovers to the rest of the world. Because for the rest of the world, when you have so much of debt being issued by the U.S., that can crowd out the borrowing from other countries. Their cost of borrowing goes up, and their debt servicing costs go up by much more. So, I wouldn't say the U.S. has a debt sustainability problem now, but at the same time, when the U.S. is borrowing that heavily, that causes rates to be that much higher. It has implications for the rest of the world and for corporations and households in the U.S.
How much higher? I mean, could you see rates staying here between 525 and 550 for the rest of this year, for even into next year?
That would not be our baseline. We would expect to see rates coming down. So right now it's for getting inflation back to target. So we expect that will come down. It's going to take a little longer, but we expect that to come down. The question is whether it comes back down to what we saw in the decade after the GFC. And there, right now, that doesn't seem to be the case.
That's IMF First Deputy Managing Director Geeta Gopinath speaking with our colleague Lisa Abramowicz. And Australian Treasurer Jim Chalmers says next month's budget will cut the growth outlooks for most major economies, including key trading partner China. Chalmers says Middle East tensions are casting a shadow over the global economy, compounding concerns about lingering inflation and weaker growth. He says these headwinds were central to his discussions last week in Washington with G20 finance ministers, the IMF and the World Bank. Plenty more to come on Daybreak Asia. This is Bloomberg. Elon Musk has decided to postpone his trip to India. He's blaming the delay on pressing issues at Tesla, which spent the weekend cutting prices for its cars and driver assistance software. And that's ahead of earnings expected to confirm a first revenue decline in 4 years. Musk has also staked the company's future on a next-generation self-driving vehicle concept called the robo-taxi. And for more on today's Big Take, let's bring in our global business editor, Peter Verco. Well, Peter, kudos for Tesla for cramming a year's worth of headlines into a few days. What's going on?
Yeah, great question. What is going on at Tesla? It has been a crazy week, even by Elon Musk's standards. I think it started last weekend with the news that Tesla was going to cut 10% of its global workforce, which is about 14,000 jobs. And that came out in like a late night memo on Sunday. So quite a lot of people, workers who were affected from that unawares. Then during the week, we saw the recall of the Cybertruck. Pretty much all of the 4,000 odd Cybertrucks that it's sold already have had to be recalled to fix a faulty accelerator pedal. Tesla's trying to put the $56 billion pay package for Elon that was struck down by a Delaware court back to shareholders for a vote to get that approved. And then on the weekend, the news just didn't stop with the price cuts, discounts to full self-driving package in America, and then the last-minute decision to cancel the trip to India, which was scheduled for this week. That all comes ahead of what is now shaping up to be a crucial earnings call on Tuesday. The numbers are looking pretty bad. We've also already seen a drop in first quarter deliveries, and I think what investors are going to be looking for is really some clarity from Elon Musk about what is happening at Tesla and what the strategy is going forward.
Yeah, and is that something that he's likely to deliver? Do you think he can give that level of clarity and transparency and something that's enough to try and provide comfort?
Well, who knows? You know, Musk is a mercurial character at best. 3 months ago on the earnings call, he was talking up progress on what was then known as a mass market car, which's got a price range of around $25,000, which is something investors have really wanted to see from Tesla because they need to broaden their sales base. Then midweek, that seems to have been ditched for what he called a balls-to-the-wall effort on autonomous driving and the robo-taxi. That's a pretty sharp U-turn in strategy to make with not a lot of warning. So I think there's going to be a lot of interest in this earnings call, not so much, I guess, on the earnings, but more on what Musk is going to say about the outlook for Tesla, where it's putting its resources and how much progress it has actually made on this robo-taxi.
We were talking a moment ago about whether or not he's going to be on this call, because sometimes he isn't, but it's hard to imagine how he can skip this out. And who's going to show up? Which Elon Musk?
Well, given that he canned the India trip, which would be a big deal in India. India is in the middle of elections. For Narendra Modi, it would have been quite a prestigious trip to have Musk show up. The photo opportunities for that sort of thing. He was scheduled to be there today, and he pulled the pin on that just yesterday, probably not long before he was scheduled to fly out of the US. I think he has to be on this earnings call. If he isn't, people are just going to be asking more questions about what is going on.
That was our global business editor, Peter Verco, there with what's going to be one of the key earnings announcements that we're watching for this week. But coming up, the Philippine Finance Secretary flags a possible delay in rate cuts as the peso weakens. We'll have our exclusive interview next. This is Bloomberg. Taking a look at how currencies are faring this morning, that read-through that we've really got from the screen right now is that the dollar is fairly steady against some of its major counterparts. Perhaps the Aussie dollar there a little bit more of a standout, but also tied to commodity prices and tensions around the Middle East. But what has been really the key dynamic that we've seen in currency markets this year has been that surprising dollar strength, because a lot of investors were coming into the year thinking that the dollar would weaken because the Fed would be cutting rates, but instead it's very much the flip side scenario where you've got resurgent inflation, a strong US economy. There's no need or justification for Jay Powell to reduce the benchmark. So that is certainly playing into the dynamic that you also see for the Japanese yen. They're holding very close to 155. But certainly as well, that big impact on emerging currencies. And the Philippine Finance Secretary, Ralph Recto, for instance, is warning of a possible delay in rate cuts. That's if the peso weakens past its record low of 59 per dollar. He told us exclusively that the delay should not affect the government's 6 to 7% growth goal.
For the last 20 years, we've had a relatively stable currency. More or less from 55 since 2004, 55 pesos to $1 US. Today it's something like 57. So not that bad as far as the Philippines is concerned.
Are you worried about it potentially weakening into the 59 arena? Because 57 really, I think, was a line in the sand for the Philippines, and now it feels like it's been pushed to 59.
That's a possibility. And that would affect also our ability to reduce interest rates moving forward, I suppose.
So if we see the peso weaken past 59, potentially you're going to have to hold off on interest rate reductions.
That's right.
Wow. That's a big statement. Potentially how much?
Potentially,
yeah, but how it's impacting all of this.
That's right.
Do you think because, starting where we started with Yellen, having this meeting with her counterparts from South Korea and Japan, do you think because the United States needs South Korea and Japan and the Philippines, similar, as partners against China, you almost have a little bit more leeway if you wanted to intervene and prop up the currency?
Not so much insofar as against China, but it's more about economic cooperation between the Philippines, the U.S., Japan, ASEAN, Korea. Not so much about propping up the currency, but even if we hold off in reducing interest rates, we expect the Philippine economy to still grow between 6 to 7% this year.
So even if you hold off on reductions?
That's right. That's right.
What is the growth outlook for the Philippines, though, if we do continuously see a stronger dollar and potentially the Fed hold rates into next year, which is what one Fed governor said yesterday, potentially?
Okay, well, the benefit to the Philippines is that our revenues increase with a higher foreign exchange U.S. dollar. Second, we have a robust OFW remittances, and we have a strong BPO industry. So we earn something like $100 billion, including exports and tourism, roughly in a year.
It's Philippine Finance Secretary Ralph Recto speaking exclusively with Bloomberg's Amory Ordern. Time to check some of the stocks to watch when markets open in Hong Kong and mainland China. Keep an eye on Asian chip and AI-related stocks after Nvidia tumbled by the most in 4 years on Friday, and that led a broad sell-off in US tech shares. Asian EV makers going to be in focus as well. This is after Tesla reduced prices of its best-selling models and the latest sign of persistent weakness in demand. Okay, let's take a look at how we're tracking for futures as well. Before we get to that, though, Belle, you got some breaking news about Honda.
Yeah, that's right. This is actually a scoop that's just come out from Bloomberg here. We're hearing that Honda is nearing a deal with Canada to produce electric vehicles. This is a Japanese firm, of course, but looking to build EV vehicles and their components in the province of Ontario. So that's what we're hearing from sources. The deal could actually be announced within days here, but it does involve a multi-billion-dollar commitment by Honda for new facilities. That's what we're hearing from sources. We said not yet announced publicly, but we will be tracking Honda. You can see they're around 1.5% to the upside. But that's it from Daybreak Asia, and our markets coverage continues as we look ahead to the start of trade in mainland China and Hong Kong.